Hi, a very good morning to all the members of the media and to all of us as well who is joining and tuning in live from LinkedIn. Thank you for joining our virtual press conference in conjunction with the release of our flagship publications. And that will be our Annual Report 2021, Economic and Monetary Review, and our Biannual Financial Stability Review. Without further ado, I would like to pass the floor to Governor Shamsiah to start her presentation. Governor, over to you.
Thank you, Janwi. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh dan salam sejahtera. Setelah lebih 2 tahun ekonomi dunia dan negara kita berhadapan dengan cabaran pandemik COVID-19, keadaan ekonomi kini semakin pulih, terutamanya dengan kadar vaksinasi yang tinggi dan pembukaan semula aktiviti ekonomi. Walau bagaimanapun, trend pemulihan ini berdepan beberapa cabaran yang perlu ditangani dengan sebaiknya. Please allow me to continue in English as we are addressing an international audience. In essence, the Malaysian economy is expected to strengthen in 2022. Notwithstanding, there remains significant uncertainties that could shape the recovery path. Developments surrounding COVID-19 will continue to influence Malaysia's growth prospects. Heightened geopolitical tensions stemming from the military conflict in Ukraine, rising commodity prices, and volatile financial conditions will also shape the outlook. In this operating landscape, policies remain in place to support vulnerable segments. Looking further ahead, Malaysia needs to remain focused and make further progress on the implementation of key structural reforms that have already been identified and announced. This is to ensure that the economy emerges from the crisis stronger and more resilient. These include advancing initiatives that furthers a conducive investment climate and enhances long-term competitiveness. Let me begin with the global economic landscape in 2022. The outlook will be shaped by 3 factors. First, the state of the pandemic. Higher vaccination coverage and the introduction of new medications will allow countries, including Malaysia, to transition to endemic management of COVID-19. However, severe resurgences could still disrupt economic activity. Second, the ongoing military conflict in Ukraine. This is expected to weigh on growth prospects via several channels, including the disruptions from the trade and financial sanctions, higher commodity prices, and volatile financial markets. And finally, the normalization of policy support in an environment of high inflation and recovery in demand in the advanced economies will have a bearing on the global economy and possible tightening of financial conditions. Overall, global economic activity is projected to continue its recovery. We are projecting the world growth will grow between 3.8% and 4.3%. This will lend support to Malaysia's external sector. The continued expansion in external demand and the global uptake cycle will benefit our economy, especially for Malaysia's E&E products, which account for more than a third of our exports. Growth of global semiconductor sales continues to remain well above its long-term average. With commodities accounting for more than 10% of total exports, the higher prices would provide further impetus to Malaysia's growth exports. Travel receipts are expected to rebound after the trough in 2021 with the reopening of our international borders and as more countries gradually relax their international travel restrictions. Nevertheless, the rebound in international tourism activities is expected to be gradual given the risk aversion and international travel restrictions that still remain in some places. Another key factor surrounding the outlook landscape is COVID-19. Malaysia, we have one of the highest vaccination rate vaccination coverage globally. This chart shows that almost 100% of adults in Malaysia have been vaccinated, and the statistics here includes the migrant population. And the pressure on Malaysia's healthcare system has been manageable. Against this, Malaysia will begin its transition to endemicity on 1st of April. The transition will be proportionate and fully calibrated. While certain SOPs and public health measures such as mask wearing, self-testing, and quarantine requirements remain, we do not expect broad nationwide containment measures as seen in the past 2 years. An increase in economic activities would lend to further improvements in employment prospects this year. Following this, both unemployment and underemployment rates are expected to decline gradually for the rest of the year. The continued high job placement rates since the end of last year also indicate encouraging signs of strong pace of hiring in 2022. Targeted policy measures also remain in place to support vulnerable segments affected by the pandemic. Upskilling and reskilling initiatives will also continue to facilitate the redeployment of workers. Over the long term, structural reform initiatives such as raising the quality for education and strengthening active labour market policies would ensure a more resilient and agile workforce. Improvements in labour markets are expected to support higher household spending. Employment and income outlook for the year remain positive, underpinned by latest data and the expected salary increases by Malaysian employers. Furthermore, the absence of strict containment measures would contribute towards an improvement in consumer confidence and spending. We are already seeing recovery in mobility and spending indicators as compared to last year. Some segments of households may continue to be affected given the uneven recovery across economic sectors and rising cost of living. We are carefully monitoring the high debt levels among Malaysian households. While our household debt to GDP ratio has declined to about 89%, it still remains on a high end compared to regional economies. However, the median debt service ratios of newly approved and outstanding household loans, they remain at prudent levels at around 44% and 35% respectively. Improvements in the labour market and targeted assistance will further support debt servicing capacity. Notwithstanding, further unbridled debt accumulation can potentially weaken household spending power and future resilience against financial shocks. Overall investment is expected to rebound and register a positive growth of 6.3% in 2022, driven by further capacity expansions and increased technology adoption. There was a sharp increase in net FDI inflows and high number of approved investments last year. These have surpassed pre-pandemic levels. The realization of these investments, particularly in the E&E and metal products industries, would support the overall recovery. Furthermore, investment will be supported by pandemic-induced shift towards technology-based operations, higher ESG-related capital spending, and continuation of large infrastructure and digitalization projects. Importantly, various policies remain in place to support the economic recovery in 2022 and beyond. At the same time, reforms are ongoing on multiple fronts to secure a sustainable and inclusive economic growth over the longer term. This includes initiatives to create a future-ready workforce, enhance digital and physical infrastructure, strengthen the adoption of ESG practices, and accelerate social protection reforms. Given headlines surrounding global commodity prices, the outlook of inflation is of particular interest. In the last few months, we have seen these global cost pressures from grains, maize to wheat translating into higher prices for selected consumer items such as fresh chicken, eggs, and bread. So in this environment, headline inflation is projected to average between 2.2% to 3.2%. This is amid several policy interventions, namely fuel price ceilings, electricity rebates for households, and price controls on some staple food items. This would, in part, contain the pass-through from global cost pressures. Core inflation is expected to average higher between 2 to 3%. This reflects improvements in demand conditions amid elevated costs. Overall, the inflation outlooks remain susceptible to upside risk, particularly from cost push factors. This includes a more persistent uptrend in input costs due to the higher global commodity prices and prolonged supply chain disruptions, which could be exacerbated by geopolitical tensions. To provide more context, higher consumer inflation is materializing worldwide, but it has been more severe in some countries than others. This reflects country-specific factors at play. Malaysia cannot be fully insulated from this global inflationary trend. However, spare capacity in the economy and labour market have partially contained the impact at this current juncture. As mentioned, policy interventions for key consumer items have also been critical. In addition, pandemic-related disruptions such as higher shipping costs and labour shortages have been relatively less acute compared to some other economies. We discussed this in further details in a box article in our EMR, and that box article is entitled An Anatomy of Inflation's Effects from the Prolonged Pandemic. So I would encourage everyone to take a look at that article. Despite manageable overall headline inflation, this is not to say that some households are not experiencing difficulties. In the past few months, we have seen rising price pressures in selected items. Some of these are essential food items, giving rise to cost of living concerns. The impact has been more on the lower income households who spend a greater portion of their spending on food. Given their smaller net income, they inevitably face greater difficulty sustaining spending in the face of rising prices. Price controls are in place to ease the burden. Nonetheless, such short-term measures will not prevent this issue from recurring and may result in unintended consequences, such as reducing the margin of players within the supply chain that could in turn lead to potential shortages of price control items. Of importance are structural reforms to tackle the root of the problems. These include efforts to improve income, address inefficiencies along the supply chain, and encourage quality investments in agro-food sector to ensure resilience against future shocks. Taking all these challenges and developments into account, the Malaysian economy is thus expected to record higher growth of between 5.3 and 6.3% in 2022. Despite the challenging operating environment, particularly developments surrounding the pandemic, geopolitical conflicts, and price pressures, growth would continue to be driven by both external and domestic demand. International tourism activity is also expected to pick up amid the reopening of international borders. On the domestic front, improvements in labour market conditions, continued capacity expansions, higher technology adoptions, with continued targeted policy support for vulnerable segments would underpin the spending by both households and businesses. Nevertheless, risks to the economic outlook remain tilted towards the downside, as shown in this chart. Downside risks stem mainly from more severe pandemic-related shocks, such as the emergence of vaccine-resistant VOCs, as well as continuous rise in cost pressures. Notwithstanding, there remains some upside potential to the outlook, and this can stem from higher than expected global growth, stronger than expected improvement in tourism-related sectors, and the smooth implementation of the recently announced increase in the minimum wage. Turning to monetary policy, the OPR was kept at its historical low of 1.75% last year. This was to maintain support to the economy as the pandemic persisted. For 2022, monetary policy will be focused on facilitating a sustainable economic recovery while preserving price stability. This includes ensuring that the degree of accommodation is consistent with the improving economy. While we do expect economic recovery to continue, the highly challenging operating environment does add a layer of complexity in assessing the balance of risk to inflation and growth. So given these prevailing and significant uncertainties, the stance of monetary policy will continue to be determined by new data and information. Ultimately, should the economic environment warrant monetary policy adjustments, they would be gradual and measured, so to not disrupt the recovery process. In this chart, you can see financing remains forthcoming. For businesses, growth in outstanding loan was supported by robust working capital financing for both SMEs and non-SMEs. Meanwhile, growth in loans to households remain healthy. This continues to be driven by loan for the purchase of residential property. Going forward, financing will continue to support economic activity in line with banks' targeted total loan growth of between 5.4% to 6.4% by the end of this year. Banks' loan impairments remain low and stable. Nonetheless, banks continue to be vigilant in managing credit risk given the uneven pace of economic recovery. In the second half of 2021, loans with increased credit risk or Stage 2 loans under MFRS 9 increased further in line with banks' expectations of higher credit losses as supporting measures are gradually unwound. Banks have built up significant buffers through higher provisions set aside against a potential rise in impairments. Overall provisions stood at 2% of total loans, with the aggregate loan loss coverage ratio remaining around historically high levels at 143%. Under the bank's updated stress test of two hypothetical adverse scenarios, loan impairments are estimated to rise nearly fivefold from current levels, with banks' profits shrinking by more than a third. Nevertheless, almost all banks were able to maintain capital ratios above regulatory minima, indicating banks' ability to support lending as the economy recovers. Notwithstanding this, we cannot let our guard down. The bank's box article, Recovery Prospects in a Global Economy, Lessons from a Corporate Balance Sheet Perspective, highlights rising corporate debt globally amid higher financing needs triggered by the COVID-19 pandemic. For Malaysia, using the same definition used by the BIS that will facilitate comparability, corporate debt has risen from the past decade from 60.4% to 70.5% of GDP. So going forward, policymakers would need to balance short and long-term goals for a sustainable global recovery. In the article, we outline three important priorities for policymakers. First, policy support must be timely, direct, and proportionate to shocks. Large-scale policy measures have cushioned the economic downturn during the pandemic. But as economic conditions improve, we need to normalize the level of policy support. Second, structural reforms such as improving labour market flexibility and having stronger insolvency laws could speed up the reallocation of resources and increase productivity. Third, while well-capitalized banks are vital to ensure macroeconomic and financial stability. Looking back over the decades, phased structural reforms have underpinned Malaysia's economic growth. In industrializing and enhancing physical connectivity in the 1980s and 1990s, followed by enabling modern services in the 2000s. This recovery period presents an opportune time to institute key reforms for a better future, to create higher quality jobs for Malaysians, which will increase the resilience of our workers and households. Malaysia must remain focused on making further progress in the implementation of key reforms that have already been identified and announced. These include initiatives to further sustainability, automation and digitalization, as well as inclusivity. To complement this, it is important to effectively execute national strategies and ongoing policy reforms under the new investment policy to accelerate the realization of quality investment that can provide better employment and income prospects for all. This can ensure that Malaysia emerges from the crisis stronger and more resilient. Our development priorities for financial sector are also aligned with these strategies. Our immediate focus will be on implementing near-term and initiating longer-term priorities outlined in our launch financial sector blueprint to ensure that the financial sector continues to serve the needs of the real economy. The priorities are summarized in this chart. These initiatives will complement the bank's ongoing efforts to preserve financial stability, including regulatory enhancement to address risk, promote fair treatment of consumers, and ensure efficient payment infrastructures. Sustainability remains one of the bank's key focus areas in 2022 and over the medium term. We aim to further enhance the capacity of the financial sector in supporting and enabling the orderly and just economic-wide transition for Malaysia through our policies and operations. This chart summarizes 5 areas of priorities. We have been working together with the financial sector, business community, and relevant ministries and government agencies to develop customized finding and risk mitigation and protection mechanisms. We are reaching out to the SME community to create greater awareness on climate risk and need to transition, as well as working with the CEO Action Network. We are also accelerating efforts to develop the alternative finance market alongside the Securities Commission Malaysia. Moving forward, the financial sector will integrate climate-related risks and aligning climate targets with their business strategies and operations, nurture and assist their clients in embedding sustainable practices in their operations, and develop sustainability-linked and transition finance solutions. Finally, let me briefly report on the bank's financial position. For the year 2021, the financial position of Bank Negara Malaysia remains sound. As at 31st December 2021, total assets amounted to 551.6 billion ringgit. And out of a net profit of 12.8 billion ringgit that we generated last year, 7.8 billion ringgit was transferred to the General Reserve Fund and 5 billion was paid as dividend to the government. I have now reached the end of the briefing. Allow me to conclude. Malaysia's economic growth is expected to improve to 5.3% to 6.3% in 2022. This projection is underpinned by continued external demand and improvements in domestic demand. Headline inflation is expected to range between 2.2% to 3.2% as domestic measures partly mitigate pass-through from global price pressures. However, we are operating in a highly challenging environment. As such, risks are tilted to the downside, mainly stemming from both COVID-19 and geopolitical developments. Apart from fiscal measures, monetary policy and financing conditions remain supportive of growth. And let me again stress the importance for us to advance structural reforms now to ensure that the Malaysian economy emerges from the crisis stronger and more resilient. With that, I conclude my presentation. Thank you.
Thank you for the presentation, Governor. For those who are tuning in, do note that you can download our annual report, Economic and Monetary Review, and the Financial Stability Review at bnm.gov.my/AR2021. Thank you so much for tuning in.